What if I told you that right now, while everyone's panicking about their portfolios dropping, the smartest investors are quietly loading up on stocks that could deliver massive returns in just the next 6 to 8 weeks? Yeah, you heard that right, 6 to 8 weeks. While your neighbor is stress eating over his red portfolio, the real money is being made by those who understand one simple truth. The best time to buy is when there's blood in the streets. And folks, there's blood everywhere right now. Welcome to Stock Vibe, where we cut through the noise and show you exactly where the smart money is moving. I'm about to reveal 3 stocks that are so oversold right now, they're practically begging to be bought. But here's the kicker. I'm also going to warn you about one sector that everyone thinks is a safe haven, but it's actually a trap waiting to snap shut on unsuspecting investors. Before we dive into these game-changing picks, do me a solid. Smash that subscribe button and hit the bell icon, because the strategies we share on this channel have helped thousands of investors spot opportunities that others completely miss. Trust me, you don't want to miss what's coming next. Now let's talk about what's really happening in the market right now. The S&P 500 is only down about 2% from its peak. Sounds manageable, right? Wrong. That headline number is hiding a bloodbath underneath. We're seeing former market darlings, stocks that everyone loved just 3 months ago, down 30%, 40%, even 50%. This isn't just a correction. This is a complete philosophical shift in how the market is behaving. Think about it. Last year, from May all the way through December, the market moved in one direction. Momentum stocks kept climbing higher. Tech stocks, semiconductors, AI plays, they were unstoppable. Everything was going up. If you weren't in those names, you were basically leaving money on the table. But here's what most people don't understand. Markets don't move in straight lines forever. What goes up must come down. And what's been beaten down relentlessly is exactly where the opportunity lies right now. We're witnessing something called reversion to the mean. It's a fancy term for a simple concept. Stocks that got too expensive are coming back down to earth. Stocks that got too cheap are finally getting their moment in the sun. The hot names from last year are getting destroyed, but the unloved, forgotten sectors are quietly rallying. Home builders are surging. Consumer staples like Pepsi are climbing. Gold stocks had an incredible run. This is the rotation everyone was waiting for, and most investors are missing it because they're too busy watching their favorite tech stocks bleed. Now, before we get into the specific stocks, let me explain the strategy here. This isn't about throwing darts at a board and hoping something sticks. We're looking for stocks that are statistically, measurably oversold. I'm talking about stocks trading so far below their 50-day moving average that history tells us they're due for a bounce. Here's how it works. Every stock has an average price it tends to trade around. That's the 50-day moving average. Most stocks hover somewhere between 5% and 8% below that average during normal corrections. But when a stock drops 20% below that average, that's when alarm bells should be ringing. Not sell alarms, buy alarms. Think of it like a rubber band. Hey, you can stretch it a little bit and it's fine, but stretch it too far and it's going to snap back hard. That's exactly what we're looking for. Stocks stretched so far below their normal range that the snapback could be explosive. And the beauty of this approach is that it limits your downside. When a stock is already down 20% or 30% and trading way below its average, how much further can it really fall? The answer is not much. But the upside, that could be 25%, 30%, even 50% in just a matter of weeks. All right, let's get to the first stock. And I'll warn you right now, you're probably going to think I've lost my mind. Software stocks. Yeah, I said it. The sector that's been absolutely annihilated over the past few months. I'm talking about the software ETF, ticker symbol IGV. Before you click away thinking I'm crazy, hear me out. Software stocks have been destroyed. Oracle is trading at less than half its price from just 3 months ago. Microsoft is down 35% from its high. ServiceNow just reported an absolutely stellar quarter, and what happened? The stock got crushed anyway. This is the definition of oversold. These aren't bad companies, these aren't failing businesses. This is pure panic selling, and panic selling creates opportunity. Here's the thing about the software sector. It's not going away. Artificial intelligence isn't going away. Cloud computing isn't going away. Enterprise software isn't going away. Yes, there will be some casualties. Some companies won't survive the AI transition, but as a whole, this sector is fundamental to how modern business operates. And right now it's being priced like it's going out of business. The valuations are insane. These stocks are cheaper relative to their historical averages than they've been in years. And technically, they're so far below their 50-day moving average that even a modest recovery back to that level could generate 25% to 30% returns. That's not a moonshot prediction. That's just math. A simple move back to the average, and you're looking at massive gains. Now I know what you're thinking. What if it keeps going down? Valid question. Here's my answer. If you had to pick one sector to own for the next 2 months, where do you think there's more downside? In software, which has already been obliterated, or in sectors that are near all-time highs? The risk reward here is heavily skewed in favor of the bulls. For those of you who want the safest play, stick with the ETF. IGV gives you diversification across the entire software sector. You're not betting on one company, you're betting on the sector recovering. But if you want to get more aggressive, there are individual names worth looking at. ServiceNow looks compelling at current prices. Oracle could use another small dip, maybe another 3% or 4%, but it's setting up nicely. Microsoft has a bit more downside potential, but it's getting close to an attractive entry point. The key here is patience. You buy these names, you don't stare at your screen every 5 minutes, and you give them 6 to 8 weeks to work. This isn't day trading. This is strategic, contrarian investing. And if you're still with me, drop a comment below telling me what you think about software stocks. Do you think there's more pain ahead, or is this the bottom? I want to hear from you. Moving on to stock number 2, and this one is even more controversial. Bitcoin. Yes, Bitcoin. Right now, Bitcoin is trading around $98,000. That's down massively from its high of $109,000 back in January. Let me paint you a picture. In January, you couldn't turn on the TV without hearing someone scream about Bitcoin. Everyone was bullish. Everyone was convinced it was going to $150,000, $200,000. The hype was insane. Fast forward to today, Bitcoin has pulled back. And what's everyone saying now? It's going lower, it's doomed, the bull run is over. I've watched analysts on financial news networks literally looking like they're attending a funeral when they talk about Bitcoin. The sentiment has completely flipped. And you know what that tells me? We're close to a bottom. Here's what's happening right now. This isn't normal selling. This is exhaustive selling. This is margin calls. This is forced liquidation. People aren't selling because they want to. They're selling because they have to. They over-leveraged their positions, and now they're getting wiped out. And historically, that kind of selling happens near bottoms, not near tops. Now, I'm not a Bitcoin fanatic. I don't worship at the altar of crypto, but I do trade it when it hits extremes. And right now, it's at an extreme. Bitcoin is trading significantly below its recent averages. Historically, Bitcoin rarely stays at these depressed levels for long. So even a small move back toward the average, and you're looking at significant gains. There's an ETF that tracks Bitcoin called IBIT. It's an easy way to get exposure without dealing with crypto exchanges and wallets. Just like with software, the question isn't whether Bitcoin can go lower. It absolutely can. The question is, if you were thinking about buying Bitcoin at $109,000 and kicking yourself for missing it, isn't $98,000 a better entry point? Think about it logically. Would you rather buy Bitcoin near its all-time high when everyone's euphoric? Or would you rather buy it when it's pulled back and everyone's bearish? I know what my answer is. Some analysts are calling for Bitcoin to drop to $85,000 or $90,000. Maybe it does. But here's the contrarian take. If everyone is looking for that level, we might not get there. The market loves to do the opposite of what everyone expects. My approach. Take a small position here, not your whole portfolio, not money you can't afford to lose, a small strategic position. If it dips lower, add more. Dollar cost average your way in, but don't sit on the sidelines waiting for the perfect bottom, because the perfect bottom only exists in hindsight. Leave a comment and let me know. Are you buying Bitcoin at these levels, or are you waiting for lower prices? Now let's talk about stock number 3, and this one is a bit different from the first two. Albertsons, ticker symbol ACI. This is a supermarket chain. Before you yawn and click away, let me tell you why this is interesting. Actually, you could pick almost any grocery stock right now, grocery outlet, Sprouts Farmers Market. They all look similar, but Albertsons stands out for a few reasons. First, valuation. This stock is trading at about 8 times earnings. That's cheap, really cheap. Second, it was a takeover target that fell apart due to antitrust issues. But here's what people aren't paying attention to. The company used that time to improve margins, grow revenue, and expand their customer base. They're one of the largest grocery chains in the country, and they're finally starting to get some respect. From a contrarian perspective, this makes perfect sense. Grocery stocks were among the worst performers last year. Nobody wanted them. Why would you own a boring grocery store when you could own the next AI stock that's going to 10x? But here's the thing. Markets rotate. What worked last year doesn't work this year, and what didn't work last year is starting to work now. Albertsons isn't a bottom fishing play. It's already started to move higher. It's off the lows. But I still see 20% to 30% upside over the next several weeks. And here's why grocery stocks are working. They're defensive. No matter what happens in the economy, people need to eat. It's a mandatory market. During uncertain times, investors rotate into defensive sectors, and groceries are as defensive as it gets. Last year, nobody cared about staples. Everyone was chasing momentum in tech and semiconductors. But now, with economic uncertainty creeping in, people are looking for safety. And grocery stocks are benefiting. This is part of the broader rotation we've been talking about. Money is flowing out of high-flying growth stocks and into steady, reliable, defensive names. If you're looking for a play that's already showing momentum, already moving in the right direction, and still has plenty of upside left, Albertsons fits the bill. And again, you could apply the same logic to other grocery stocks. The whole sector is setting up nicely. Now here's where things get really interesting. I've given you 3 contrarian buys: software, Bitcoin, and groceries. But there's one sector that everyone thinks is safe, everyone thinks is a buy on the dip, and I'm here to tell you it's a trap. Gold and silver mining stocks. I know, you're probably shocked. Gold has been on fire, silver has been exploding, the mining stocks have had an incredible run. And that's exactly the problem. They've had too good of a run too fast. Let me explain. Gold doesn't move 30% in a year very often. Silver doesn't shoot up 50% in 6 months, but that's what just happened. And when you see moves like that, it's not just fundamentals driving the price. It's mania, it's euphoria, it's everyone and their grandmother piling in because they don't want to miss out. The move in gold and silver has discounted a lot of the geopolitical uncertainty, a lot of the economic fear. The early part of the rally made sense, but the tail end, that was pure speculation. That was the crowd piling in. And when the crowd gets involved, the smart money gets out. Right now, gold mining stocks are just starting to pull back from their highs. And I'm telling you, they have further to fall. They're still trading too far above their 50-day moving averages. They need to come back down to more reasonable levels before they represent a good buying opportunity. Stocks like Newmont Mining, Barrick Gold, Agnico Eagle, they all need to cool off. I'm not saying short these stocks. I'm not looking to profit on the downside. I'm simply saying, if you're thinking about buying gold miners right now, wait. Give it 6 to 8 weeks, let them pull back, let the hype die down. And then, when everyone's bearish on gold again, when people are calling it a dead trade, that's when you buy. This is Contrarian Investing 101. You don't buy when everyone's excited, you buy when everyone's given up. And right now, everyone's still too excited about gold. The best opportunities come when nobody wants them, and gold mining stocks, everybody still wants them. So to recap, 3 buys, software stocks, specifically the IGV ETF, or individual names like ServiceNow and Oracle, Bitcoin, either directly or through the IBIT ETF, and grocery stocks like Albertsons. One to avoid? Gold and silver mining stocks. Let them cool off before jumping in. Here's the thing about contrarian investing. It's uncomfortable. It feels wrong. You're buying things that are falling and avoiding things that are rising. It goes against every instinct you have, but it works. The greatest returns in the market don't come from following the crowd. They come from going against it. If this video has given you a new perspective on where to find opportunity in this market, do me a favor. Hit that like button, share this video with someone who's been freaking out about their portfolio, and most importantly, subscribe to Stock Vibe if you haven't already. We're building a community of smart investors who think independently and act strategically. Drop a comment below and let me know which of these plays you're most interested in. Are you brave enough to buy software stocks right here? Are you loading up on Bitcoin? Or are you playing it safer with grocery stocks? I read every comment and I want to hear your thoughts. And if you disagree with me on gold, tell me why. Let's have a real conversation. Remember, the best opportunities in the market come when things look the worst. When fear is high and uncertainty is everywhere, that's when fortunes are made. Don't be the investor who waits for everything to feel safe and comfortable. By then, the gains are gone. Be the investor who acts when others are paralyzed. That's how you win in this game. Thanks for watching Stock Vibe, and I'll see you in the next one.